Hi everybody, Jeff Yastine here. You know, the current poster child for most hated stock on Wall Street is most certainly General Electric, and yet the performance of the stock shows why it pays big time to monitor the share purchases of corporate insiders. You know, we're talking about insider purchasing here. Now, I harp on this all the time, so does my colleague Brian Christopher, who runs Insider Profit Trader here at Total Wealth Insider, and we follow insider purchases for a good reason. It works as a method. Now, back on December 5th, GE was trading at $7 a share, and it was about as unloved a company on Wall Street as it could be. It's still out of favor even now. As for myself, I noted back then that GE insiders had recently purchased nearly $3 million in stock. I like it, I wrote, when a new CEO, Larry Culp, buys a big chunk of his own stock. And I love it when he doubles down and buys even more when the stock's heading lower amid a blizzard of bearish headlines, as GE shares were doing at the time. And since then, as you can see from the chart, GE shares are up nearly 40%. Now, a month's worth of data doesn't mean the coast is clear. It's not all rainbows and unicorns from here. But when insiders, executives, board members, institutional shareholders, when they put their own money at risk with regular shareholders, to me, there's no better demonstration of corporate leadership and increasing the odds that a stock will sustainably move higher over time. But getting back to GE, what about now? Well, it wouldn't surprise me to see the stock move back a little bit from here. It's had a nice pop, and it's important to remember that all the immediate good news is on the table now. We know GE has plenty of cash flow to meet its obligations, and there's no nasty surprises that were in its quarterly numbers that were issued last week. So all that taken into context, it means that there's plenty of time for bad news bears to go back to work on a stock like this. But the thing that analysts often don't take into account in their spreadsheets, probably because it's just hard to quantify, is something that I talk to my subscribers at Total Wealth Insider about all the time. It's the idea that stocks and stock markets anticipate future events, both good and bad. In other words, when GE stock was falling 80% back in 2017 and 2018, it was discounting the future events, the worries that analysts are talking about now. And the stock's rise means that GE analysts, while they may be puzzled, the smart money, the smart investors who are buying it now are not looking at the worries that analysts are writing about today. They're looking forward to future positive announcements that are going to change the tone on the stock. Those announcements coming from Larry Culp and the rest of the executive core at General Electric. Now, at some point, GE analysts will no doubt begin to declare the existential threat to the company over with. But by then, the stock will be much, much higher. And that's an important lesson to remember, not just about GE, but about for any stock that we may be considering for purchase. If its price is high, how much of that is already reflected in great news that's already sort of come and gone? And if the price is low, how much of that is already discounted as well in bad news that's well known to the investor community? Something to consider going forward here. If you like what I'm talking about, remember to click the screen. I'm Jeff Yastine.